Welcome to the deep dive. Today we're jumping straight into the deep end of institutional finance. We got our hands on some pretty incredible source material.
Yeah, this is the foundational lesson from a private, very high-level trading mentorship. It's all about institutional market structure and precision trading.
And what's wild is that it doesn't start with charts or, indicators. It starts with philosophy.
It really does. It challenges, it completely upends the core beliefs of most retail traders. Our mission today is to unpack this one central idea.
Which is?
That price movement isn't random. It's not just a reaction to news or economic events. The claim is that it's an engineered pursuit of liquidity, and it's orchestrated by some very, very powerful entities.
Okay, so we're going to figure out who the real market makers are.
Exactly, and why understanding that changes absolutely everything for anyone who wants to trade seriously.
Let's get right into it then, because before you see a single candlestick, the program lays down this incredibly dramatic rule. They call it the Fight Club rule.
Right. Rule number 1, you do not talk about what you learn here. And, maybe even more importantly, you do not talk about what you are planning to do in the market.
That is, wow, that's a heavy mandate from the get-go. We're talking professional isolation.
Total isolation. Forget your trading buddies. Delete your stock chat apps. It's serious.
So why? Why is the secrecy so critical?
It all comes down to the cold, hard reality of the market. Trading is a zero-sum game, period.
For every dollar you make, someone else somewhere has to lose that exact dollar.
And vice versa. It's a direct transfer of wealth. There is no, collective gain where everyone wins.
And the institutions, they have a name for this, right? Market pairing.
Market pairing or order pairing. It just means the system is designed to be perfectly balanced. If you put in a buy order for 100 shares of, say, the S&P 500, the system guarantees that 100 shares are sold to you. Liquidity is guaranteed. But the dangerous part is what happens when you share your plans.
Your stop-loss placement, for instance.
Exactly. Your stop losses, your profit targets, your entry points. The source calls these specific liquidity risk factors.
So you're basically just painting a giant target on your back.
A giant one. The market is a huge pairing engine. And if you announce where your money is, you make it trivially easy for the high-frequency funds, the big institutions, to pair against you.
And they have the tech to do this automatically.
Oh, absolutely. The source is very clear. There are advanced algorithms funded by entities with, and I'm quoting here, unlimited funds that actively scrape that sort of information.
So that tweet about your trade idea.
You are literally funding the technology that is designed to take your money. You're giving a competitive advantage to the players who are actively hunting for your stop.
That's a profound shift in thinking. It means trading has to be a solitary profession.
Completely. You operate in silence, in perpetuity. You are up against the fastest tech and some of the smartest minds in the world. You just can't afford to give them any free data.
It's an incredible level of self-discipline before you even place a trade.
It is. You have to kill the social aspect of it. If you want to win, you have to accept you're taking money from someone else, and the moment you talk, you invite them to take yours instead.
Okay, so if rule 1 is silence, because it's a zero-sum game, that implies that the reasons we think the market moves are probably wrong.
It's the perfect setup for the next big idea, what the sources call the fundamental fallacy.
The idea that news matters.
The idea that news is the primary driver. Headlines like DeepSeek AI panic or Trump's tariffs. The belief that these events are what's really moving price up and down. This mentorship says that is the single greatest misconception in trading.
But hold on. If the Fed hikes rates, the market goes crazy. A war breaks out. Oil prices shoot up. You can't say that's not real.
It's real, but it's not the engine. It's the fuel. The news is the fuel for a move that was already being planned.
Okay.
The source uses a really good analogy. Think of the global economy as the entire vehicle. It's this huge thing moving along on its own path.
Right, the big picture.
Inside that vehicle, you have the markets. That's the engine. It's what translates the economic energy into price action.
And this is where the twist comes in. The market maker. They're not the engine itself.
No. They're a small but critical component, like the alternator or a tiny gear. It's a small part, but it facilitates and, more importantly, it directs how the entire engine functions.
And their definition of that market maker is, well, it's controversial. It's not who you think it is.
Not at all. It's not the traders with fancy titles at Goldman Sachs or JP Morgan. The source states this over and over. The real market maker is the central bank.
Wow. So the central bank isn't just a regulator. They're actively driving price. They are the ultimate liquidity provider.
And if they are the provider, what does that make everyone else?
Yeah, the liquidity.
You're the liquidity, willing or unwilling. You, the speculative trader, the uniformed money. The market maker needs your orders to fulfill their objectives. The news story just provides the cover, the rationale that gets you to participate right where they need you to.
And they call this the efficient market paradigm, a system designed always to benefit the market maker and punish the retail trader who's just following the headlines.
Exactly. The system needs you to believe in the news. Otherwise, you wouldn't place your stops in the obvious places they are intentionally building.
This gets us to the mechanics of it. If the central bank is engineering these moves to hunt liquidity, we have to learn to see the chart the way they do.
Right. And the source contrasts two different views of the exact same chart. First, there's the uninformed view.
Which sees things like area of support and area of resistance, people using moving averages, Elliott wave, trying to predict what should happen next.
But the market maker, they see something totally different. They are only, and I mean only, concerned with reaching into liquidity. They don't see support or resistance. They see pools of money.
And those pools of money are sitting in very predictable places.
Engineered places. Buy stops are always resting just above obvious swing highs. Sell stops are resting just below obvious swing lows.
And the most important part of this is that the structure itself, the swing highs and lows, they aren't natural.
No. They are actively engineered by the market maker through manipulation. They are built specifically to create those pools of liquidity.
That just reframes everything. So what looks like a normal price consolidation to me is actually a pre-planned construction site for a future liquidity grab.
That's the perfect way to put it. It's an irresistible target for stop-loss orders.
So how do we spot these targets on a chart? What are the visual cues?
The source gives a few specific things to look for. First, find areas where price made a sharp or quick move away from. That usually signals institutional footprints.
And the really crucial sign is what they call clean highs or lows. What does that mean, a clean high?
Imagine a perfect horizontal shelf on the chart, a smooth area where prices tapped a level maybe once or twice and then pulled away very neatly.
Okay, I can picture that.
That is the classic pattern the market maker builds. It practically screams, "Put your stop loss right above me," to the uninformed trader. Clean highs mean clean, untouched liquidity. Messy, jagged highs usually mean the liquidity has already been swept.
And when price finally comes back to take out those stops to hit that clean area, it does it with speed.
Always. It's an aggressive, energetic move. It's designed to trap people, to trigger cascading stop orders, and give the market maker the volume they need to get their business done.
The sources also talk about looking at price not just in terms of space, up and down, but also in terms of time. Why is that so important?
Well, if the central bank is the market maker, then the daily trading sessions are their playground. The source says you must partition your charts from 12 a.m. to 12 a.m. day by day.
To see the daily boundaries clearly.
So you can study how the daily high and the daily low are formed relative to the London session, the New York session, the Asian session. You start to see these patterns where one session builds the trap and the next one springs it.
This all leads to the path forward for the learner. If you accept this philosophy, the next step is all about mindset and just doing the work. The first rule is psychological.
Yeah, trading is all about mastering yourself. You have to be an analyst and executor, but you cannot be a gambler. You have to eliminate emotional reactions like revenge trading.
Trying to win back the money you just lost.
It's the fastest way to blow up your account. It's the total opposite of the discipline required.
And the source sets some really tough but realistic expectations. Number one, you will lose money.
And you have to accept it. You have to treat it as a learning opportunity, not a failure. They even say losing in a demo account with fake money still hurts your psyche. Every loss is tuition. You have to learn from it.
Second expectation, you will not profit on every setup and you will miss opportunities. This is about fighting FOMO, the fear of missing out.
Right. And this is where capital preservation becomes rule number one. It's more important than making a profit. You have to be okay with taking a small, planned loss or just sitting on your hands and not trading at all.
And the third one, which feels connected to the Fight Club rule, is brutal. There is no shortcut to riches.
None. Success is measured in tiny, small, incremental steps. You have to submit to time and let it do the heavy lifting. The source actually says that very intelligent people, like doctors or scientists, often fail at trading.
Why is that?
Because they try to outsmart the market, instead of just submitting to the simple, difficult, consistent groundwork that's required. Time, they say, is king.
So what does that groundwork actually look like? What's the toolkit?
It's surprisingly simple. You need a time-based candlestick chart, something like TradingView. And they say to start with historical data only, no live money, no paid subscriptions, and you need a study journal.
And the journal is more than just a log, right? It's your confidant.
Exactly. It's where you process everything, your thoughts, your emotions. And the rule is you must cheerlead yourself. You have to be reflective, but never, ever negative.
You have to be your own coach.
Absolutely. If you start beating yourself up in your journal, you've already lost the mental game.
So the core exercise, the daily work, what does that involve?
It's a daily price action log. They recommend doing it on an asset like the ES, the S&P 500 futures, because it has a very clean chart. The patterns are easier to see.
And there's a rigid structure for how you have to look at it.
Very rigid. You have to cycle through multiple time frames every single day. A daily chart with at least 9 months of data, a 4-hour chart with 3 months, a 1-hour chart with 3 weeks partitioned by day, and then a separate 15-minute chart looking at just the last 3 or 4 days.
And the hardest part of this whole assignment is that you are forbidden from trying to predict anything.
This is where you submit to time. The only goal is to annotate. You mark your points of interest. Where did price move away from sharply? Where are the clean highs and lows? You are building a factual log of the market's engineered structure. You're not predicting, you're observing. That's how you build the experience that becomes king.
This has been a really fascinating and, frankly, a pretty brutal look at institutional trading. The takeaways are so clear. The market is driven by liquidity engineering, not news. The central bank is the true market maker.
Right. And swing highs and lows are not barriers, they're targets.
And to succeed, you need total self-mastery and just an immense amount of silent, focused groundwork.
And if you connect all these dots, you see that the knowledge required is deep. It's complex. They even call it esoteric. Success isn't about being the smartest person in the room. It's about the simple but very difficult act of just showing up consistently.
Letting time do the work.
And letting time do the work. So when you consider the discipline required, the isolation, removing emotion, cheering yourself on through losses, it makes you think. Maybe the true zero-sum game isn't you against some other trader. Maybe it's between your disciplined analytical self and your own emotional gambling self.
Are you fighting the market or are you just fighting yourself?
Something to think about. As you partition those charts from 12 a.m. to 12 a.m.,